Good morning. Welcome to the 13th edition of the Panama interview series, where we discuss topics regarding foreign direct investment in Latin America and the Caribbean. We are streaming live from the capital city of the Republic of Panama. The Panama interview series is produced by Bico Legal and Compliance Consulting, LLC, a Miami domiciled limited liability corporation with offices in downtown Miami and Panama City, Panama. We provide international, commercial, and transactional legal and regulatory compliance advice and related services to manufacturers and brand owners that seek to boost profit and hedge domestic risk through international distribution in the USA and in Latin America and the Caribbean. My name is Anthony Robinson, and I am the managing member of Bico Legal and Compliance Consulting. In this edition of the Panama interview series, we will discuss the findings and recommendations of the 2022 Latin American and Caribbean Macroeconomic Report entitled From Recovery to Renaissance, Turning Crisis into Opportunity. This report was published in April of this year by the Inter-American Development Bank, and it was authored by our distinguished guest this morning, Eduardo Cavallo. Mr. Cavallo is Principal Economist at the Research Department of the IDB in Washington, D.C. Eduardo's research interests are in the fields of international finance and macroeconomics with a focus on Latin America and the Caribbean. He has published in several academic journals and is the co-editor of several books, including Building Opportunities for Growth in a Challenging World, a 2019 IDB publication, and Saving for Development, How Latin America and the Caribbean Can Save More and Better, a 2016 Palgrave publication. Prior to joining the IDB, Mr. Cavallo was a vice president and senior Latin American economist for Goldman Sachs in New York. Eduardo holds a PhD in public policy and a master in public policy from Harvard University and a BA in economics from the Universidad de San Andrés in Buenos Aires, Argentina. We have a number of topics to cover, so we will cover the Q&A at the end, and let's jump in. Eduardo, welcome. How are you doing this morning?
Good morning, Anthony. Doing very well. Thank you very much for the invitation. It's a pleasure to be here.
Thanks for taking the time to speak to us today. It's an honor to have you as our guest. Congratulations on the publishing of the 2022 Latin American and Caribbean Macroeconomic Report. I had an opportunity to also look at last year's report in preparation for this talk. For how many years has the IDB published the macroeconomic report for Latin America?
Yes, thank you. Let me first, Anthony, because you were extremely generous in the introduction, let me clarify I'm one of the co-authors, co-coordinators, as we call them, of this year's report. It's really a teamwork here at the research department of the IDB and also involving other areas of the bank. So it's really a huge team effort, and I'm proud to be part of that team. We have been putting out these reports once a year. I guess we started around the global financial crisis or a few years before the global financial crisis. So we are probably 10 or 15 years that we have been putting these reports, and we used to present them prior to COVID every year at the IDB's annual meeting to the governors of the IDB to discuss the outlook for the region, the topics that we consider are relevant for the region, and what kind of reforms and policies countries can implement to try to sort of upgrade the economic prospects, social prospects, and also address some of the challenges that countries in our region have.
Perfect. Well, this year's report addresses 4 topics: a new post-pandemic fiscal architecture, monetary policies for the fight against inflation, risks to external accounts, and opportunities for a great transformation of labor markets. In the limited time that we have this morning, I'd like to touch on 2 of those topics: the risks for external accounts and the opportunities for a transformation of labor markets, because these topics are particularly relevant to the prospects of growth for the Republic of Panama, which is the focus of my practice. And in closing, we will discuss the impact of climate change on GDP growth and income inequality in Latin America and the Caribbean. Your research shows that climate change is a real threat to long-term economic well-being of Latin America and the Caribbean because the communities in our region are particularly vulnerable to the indirect effects of climate change. So let's jump into the first topic, which is the risk of eternal accounts. The 2022 report explains that last year, the Latin American and Caribbean region rebounded from the single-year recession of 2020, which was the region's worst single-year recession, to grow 7% in 2021. This growth was largely due to strong performance at the global level. The report also states that the analysts initially expected growth for this year to return to long-term averages of about 2.5%. So how have recent macroeconomic and geopolitical events changed the forecast for this year of 2.5% growth in the Latin American and Caribbean region?
So, as you said, Anthony, the region bounced back in 2021 and was expected to converge to its long-run growth trend, which is lower than other regions, unfortunately, starting this year in 2022. Now, if there was uncertainty about how it would converge to these growth rates at the beginning of the years when worries were centered on possible new outbreaks of COVID and the normalization of monetary policies in the developed world, US and other countries, the uncertainty scaled up with the disruption of the war in Ukraine. Okay, so the report has a number of policy recommendations aimed at enhancing the region's buffers and key markets to speed up its recovery from COVID and strengthening, the possibilities to navigate the current tensions from the global environment. The IDB is ready to support the region in this path, as they are, all of the recommendations that we are doing in this report are closely aligned with a strategic document that we call Vision 2025 on several dimensions. They focus on how to speed up the overall recovery with the specific discussions on issues such as the reconfiguration of trade channels, promoting the recovery of labor markets with gender balance and equity, and promoting a stronger recovery of firms in the region through stronger financial markets and easier access to easier access to and lower cost of finance, which is always something very important for our country that is a net recipient of funds from the rest of the world. We are a region, we are sort of net debtors. We need financing from the rest of the world. So keeping access to financial markets, keeping the markets open and the cost of finance low is always an important objective for the region.
We're about halfway or almost halfway through the year, and we entered the year with expectations that we were positively recovering from COVID, but we have the inflation efforts that have begun in many advanced economies. We have the war between Russia and Ukraine. How have those events affected the prospects for growth for this year and beyond? Is it possible, as the report suggests, that we could see less growth or maybe see in the region recessions in 2023?
Okay, so the recession scenario for 2023, which we have in one of the scenarios in the macro report, is based on the assumption that there is more aggressive, let me use that word, monetary policy normalization in advanced economies than what was currently priced in by the markets as of the time of writing, that, as you said, this was published in April. Basically, that means more hikes in interest rates, more contractionary monetary policies to combat inflation than what was anticipated. I would say that thus far, the increases in interest rates that we have seen have followed the market expectations. So I would argue that the more pessimistic scenario has not yet materialized. Still, it's early, and one thing that we have learned from experience in our region is that shocks sometimes materialize quite unexpectedly, so we need to remain alert. Fortunately, the worst case scenario has not yet materialized, but it's important, and that's why we put it out there, to remain alert, because we know, again, from experience, that if these shocks happen, they can be very costly to the region. So it's important to be prepared, to be ready, and to have the buffers to be able to fend off and offset the negative shocks if they come.
Regarding the war between Russia and Ukraine, the IDB report this year instructs that the economic recovery in the Latin American and Caribbean region after the first year of the pandemic was accompanied by an increase in commodity prices that the war in Ukraine has reinforced or exacerbated. How are higher commodity prices affecting the Latin American and Caribbean region?
Yeah, excellent question, Anthony. So the increase in the prices of commodities will have different effects on different countries in the region, depending on whether they are net exporters or not of the relevant commodities. You know, in these types of reports, sometimes we talk about the region as if it was a single homogeneous entity, and clearly Latin America and the Caribbean is not. And one of the dimensions along which countries differ quite significantly is on whether they are net commodity exporters or importers, and even within the net commodity exporting countries, which kind of commodities they export. So, for example, net oil exporting countries in the region will certainly benefit from the price increase, or so this sort of windfall income that is generated by the higher prices of oil and gas that we are observing since the beginning of the war. But net oil importing countries, many of which are in the Caribbean region and Central America and so on, will suffer from that. A simple exercise of computing sort of the change in the current account balance, which is the amount of absorption of foreign savings that countries in the region need to do. That's the amount of borrowing that countries need to do from the rest of the world due to changes in the price of oil, and leaving everything else equal, shows a clear difference between oil importers and exporters in the region. As usually happens with changes in oil prices, nearly half of the countries in the region may benefit from the windfall. This raises very important policy questions regarding how to manage those oil price boom. I would argue, and we argue in the report, that given the current fiscal constraints facing all countries in the region and the high level of indebtedness that we have reached, given what we had to do, what governments had to do during the COVID to support the families and the economy, you know, it is worth fostering or promoting a conservative management of the oil revenues in the current context. This implies saving a large portion of any revenue windfall to rebuild depleted fiscal buffers, or to apply that to reducing debt levels. But of course, that's for the oil exporters. The oil importers will need to find ways to try to mitigate the impact of the higher oil prices on the economy. And this is very important because the second thing I would mention regarding this is that these kind of commodity price shocks have also impacts on social indicators, which we need to keep in mind. So commodity booms trigger sort of opposing effects on poverty in the region. For example, on the one hand, as the increase in prices is passed through food and gas retail prices to inflation, poverty tends to increase because the poor households are the ones who spend a larger share of their budgets on those items. So, the inflationary impact of the commodity booms is something that has negative social implications. On the other hand, commodity booms have been sort of accompanied by an increase in the demand for low skilled workers, and that helps to increase the earnings in the bottom tail of the income distribution. In addition, as in the example we just gave with countries that export oil, commodity booms sometimes tend to open up fiscal space and allow government to expand transfers to the poor and spend more on energy subsidies to try to offset these price increases. So in the very recent past, over the last 10 years, I would say, these counteracting effects have allowed poverty rates to decline in economies that are net commodity exporters. Still, as the impacts are ambiguous, policymakers will want to monitor this area very, very carefully.
Okay. Speaking more directly to risks of external accounts, the report instructs that during the global financial crisis of 2008, and as well as with the COVID crisis, Latin American and Caribbean countries were able to avoid sudden stops in capital flows. A key question that the report poses is whether Latin American and Caribbean countries will continue to be able to have a strong fiscal balance sheet, or whether there will be threats in the future of sudden stops in capital flows. So what are the policies that are needed to prevent sudden stops in net capital flows going forward in the region?
Perfect, Anthony. So let me first, to answer this question, step back for a second and explain what a sudden stop in capital flows is, because some of the people in the audience may not be familiar with the term. So I said that the countries in the region on net are borrowers from the rest of the world. That means that this is a region that on average runs current account deficits, and we need to finance those current account deficits through borrowing from the rest of the world. Okay, if for some reason those capital inflows come to a sudden stop, and it has happened in the past, that usually is something very costly and very difficult for the economies to accommodate, because it is as if in your personal life, I mean, all of a sudden you lose your credit card balance, or all of a sudden you cannot rely anymore on the credit that you receive for day-to-day transactions. For the aggregate economy, it's the same. If the economy faces a sudden stop in capital inflows, it has to adjust, usually very abruptly and usually in a very costly way, to the restriction imposed by the lack of external financing. And in the past, when we look at the experience of Latin America and the Caribbean in the 1990s, for example, or in the early 2000s, we have a plethora of examples of sudden stops imposing very significant damage to the economies. Then we had the significant shock of the global financial crisis of 2008 and 2009. And what we observed is that despite the fact that the external shock was very big, countries in Latin America and the Caribbean were able to withstand that global shock much better than the shocks of the 1990s. And when we explore why was that the case, we find that because countries entered the global financial crisis with much lower vulnerabilities compared to the situation in the 1990s, meaning fiscal accounts were much better. Countries were not running large fiscal deficits. They were running, surpluses or had balanced budgets. The amount of external uh, current account deficits was smaller. Countries had built up international reserves, and the levels of dollarization, meaning foreign currency circulation in debts in the country, were much lower. So that sort of helped countries withstand the shock much better. Fast forward to now, and then the question is, okay, we had the COVID shock, and in the COVID shock, how did countries fare? So we will talk a little bit about that. I mean, the economic outcomes associated to the COVID shock were not good for the region. Actually, the region fared pretty badly in terms of loss of GDP and financial markets. But on the external accounts, it wasn't so bad, meaning that countries that needed to could still borrow from the rest of the world. There was an increase in the lending from multilateral institutions like the IMF, the IDB, and so on. So countries could rely and could access external financing, uh, and that prevented countries from suffering a sudden stop despite the COVID shock and what was going on in global financial markets. Now, when you dig a little bit deeper, and this is really important, you find that another source of resilience for the region was the fact that, I mean, there was some offsetting, say, from the foreigners' capital flows coming from resident investors that were repatriating some of their assets to the region. So all of those elements sort of combined to help the region on the external front deal with the COVID shock fairly well. Now, nothing of that needs to or should be taken for granted because we have depleted the buffers in response to the shocks. So now the fiscal situation is much worse. The current account balance is much worse. We have higher levels of dollarization and so on. So, I mean, we use the buffers to fend off. Now we need to focus on rebuilding those buffers because we need to be prepared for the next shock. And that's a key critical message that we want to sort of convey in the macro report and something that we tell our member countries and explain to them the importance of rebuilding those buffers.
The report this year identifies key domestic indicators that determine the likelihood of sudden stops of capital flows. Those would be current account and fiscal balances, liability from dollarization, and the availability of foreign reserves, which you've spoken about. I'd like to show you your slide, your
Yes.
chart from the report that illustrates the dynamics of these indicators. Could you walk us through this slide briefly and explain how these indicators interact?
Sure. Yes, absolutely. So one way of thinking about this is that you know every crisis is sort of there's always a spark that starts the fire, but the fire will sort of the spark will start really the fire if there are sort of combustible materials out there that can burn. Okay, otherwise there won't be a crisis. So the way of thinking about these four indicators here: the fiscal balance, the current account balance, the amount of liability dollarization, and the amount of reserves being a buffer rather than a vulnerability factor, so going in the opposing way, is that these are sort of the combustible materials. So the point we want to make in this figure, in this table, illustrates a point I was making a few moments ago. If you look at the year 2007, for example, this is the year prior to the global financial crisis of 2008, and you look at the average fiscal deficit for the Latin American countries, that would be the last line in the first column. What you see there is that the current account deficit was almost inexistent, so only 0.2% of GDP on that year. The current account balance, the average current account balance was a more significant minus 3.5%. The level of liability dollarization, meaning the amount of debts denominated in foreign currency, was 20% of GDP, and the amount of international reserves was about 14% of GDP. So if I were to have included other periods in history, I would be able to argue that these numbers were sort of pretty good for the region. I mean, low fiscal deficits, limited current account deficits, relatively low levels of liability dollarization respect to previous years, and a significant amount of international reserves. So fast forward, and what was the situation in 2019 prior to the COVID shock? Well, the average fiscal deficit for Latin America and the Caribbean was now much higher, was almost 3% of GDP. So we were more vulnerable on that dimension. An offsetting factor was that the level of current account deficits was smaller, 1.3% of GDP. So we were stronger on that dimension. The level of liability dollarization was more or less the same, and the amount of international reserves was even higher than in 2007. So again, that's a positive factor. So these elements explain how the region, in a sense, was able to on the external front, avoid the sudden stop because, on several dimensions, it was better than what it was in 2007, with the exception of the fiscal deficits. But now, fast forward to now. So if a shock were to happen now, this year or next year, and so on, how would the region be in terms of the vulnerability factors? Well, the good news is on the reserves side. The level of international reserves, given that markets have remained open and so on, is still significantly high. But on the fiscal front in particular, we are much worse than what we were in 2007, in 2019, and these levels are comparable to the levels of fiscal sort of imbalances that we had in periods during the 1980s or during the 1990s. So on the fiscal side, there is really a red light there, something that we should be concerned. On the external front, current account balances and levels of dollarization, they have deteriorated with respect to what they were in 2019, but much less than the fiscal. So really, this tries to bring to the fore that the key vulnerability factor nowadays of the elements that create sort of the combustible materials that could trigger a sudden stop is sort of the fiscal situation. So the fiscal accounts are, or maybe, or could be, sort of the Achilles heel of financial stability. And this is really an area we need to pay attention to, and we need to put all of the efforts in the direction of trying to build resilience, improve the buffers, lower fiscal deficits, lower debt levels to be able to overturn this key vulnerability. I hope that was not too long of an answer, but that's sort of the message of this table.
Perfect, perfect. With respect to risks for current account financing, as the Latin American and Caribbean region recovers from the COVID-19 pandemic, your analysis has concluded that in most of the countries in the region, a significant fraction of the current account deficit is financed by relatively stable capital flows in the form of foreign direct investment. But on the other hand, the report warns that the risk of decreasing external financing is real, but it's early yet to determine or to predict how capital markets and the emerging markets will perform. So currently, where we are halfway through the year, how are emerging debt markets performing? And is there a significant risk that you see the capital flows may be interrupted in the region?
So the cost of financing for countries in Latin America and the Caribbean is the combination of two things. Basically, what would be considered to be sort of the risk-free interest rate. So think of it as the interest rate here in the United States, or sort of the cost of borrowing for the government in the U.S. The interest rate on Treasury bonds. So the interest rate per se, and the country risk spread that is attached to emerging markets and to countries in Latin America. So if you look at the spreads have been fairly stable, meaning that there hasn't been an increase in the relative perception of risk of Latin America vis-a-vis other emerging markets or advanced economies. So sort of the spreads have remained fairly stable. The problem is that the underlying rates, the rates here in the United States are going up. And they are going up because of monetary policy here in the United States is turning more contractionary. So the Fed is increasing interest rate to try to fend off inflationary pressures in the United States. And the expectation is that it will continue to do so. And you're observing sort of the same phenomena in other advanced economies. So interest rates in the advanced world are going up. And that will, given that it's one of the components of the cost of financing for our countries, that will sort of increase the cost of financing. In the past, even the suspicion that the Fed was going to tighten monetary policy or increase interest rate was something that generated a lot of volatility and triggered this kind of sudden stops to the region. Whether this time something like that will happen or not, again, hinges a lot on what the region can do in terms of rebuilding the buffers that have proven to be so important for the region in withstanding these kind of shocks during the global financial crisis and during COVID. So importantly, and that's why this is something very urgent, it's something that we need to work on to prepare, to get ready, and to have these resiliency factors back online as soon as we can, because it's inevitable, in a sense, that the trend towards higher rates in advanced economies will continue because they are fighting off the inflationary pressures that they are having in their own economy. So they need to do what they are doing. It is our job to get ready to build resilience to avoid those kind of actions hurting us in terms of the incidence of these types of shocks.
Okay, let's turn to opportunities for transformation in labor markets. The report instructs that in 2020, Latin America and the Caribbean suffered the most significant contraction in GDP and employment of any region, advanced or developing, in the world. Why was the impact of COVID on GDP and employment so much worse in the Latin American and Caribbean region than in the rest of the world?
Yes. So Latin America and the Caribbean was one of the worst affected regions by the COVID pandemic. We have 8% of the global population, but we suffered more than 25% of the deaths associated to COVID. One thing that we learned with the benefit of hindsight, considering what happened in the year 2020 and looking at the data of the year 2020 by itself, is that there was really no trade-off between saving the economies and saving lives. In other words, countries that suffered more deaths per capita also lost more in terms of economic output and employment, and vice versa. Many countries in our region likely suffered unduly on the health side due to weak health infrastructure and the patchy enforcement of lockdowns. And on the economic side, due to the initial conditions such as low growth and fiscal constraints, which then led to relatively small fiscal packages, high levels of labor informality, and insufficient connectivity to work at home. Of course, some countries suffered more than others. Tourism countries were particularly hard hit in terms of economic output, and some countries were particularly hard hit by the virus, such as, for example, Brazil, Chile, Colombia, Mexico had a lot of death. Unfortunately, Panama as well. No, an achievement, if you will, for this crisis was that several countries implemented significant fiscal packages in response to the shock, um, including what we economists call above and below the line items. But that's secondary. The point is that if you look at the region as a whole, the average package, the average fiscal package in 2020 for the region was about 485 billion US dollars, or 8.5% of GDP. Now that headline number seems contradictory with my statement before that the amount of support that was given was not very big because the number is very large. But you need to realize that that average figure that I gave you is heavily influenced by three countries, Brazil, Chile, and Peru, that were able to implement very large fiscal packages. Instead, more than one third of the 26 IDB borrowing member countries had much more limited packages, or could implement much more limited packages of 3% of GDP or less during the COVID. To put these numbers in perspective, because 8.5, 3%, I mean, they could seem, a little bit uh, abstract. The average package in advanced economies during COVID was close to 20% of GDP. So in the end, what these numbers suggest is that most countries in our region did as much as they could in terms of the fiscal stimulus, the support they could give to economies and families during the pandemic. But really, very few countries had space to do something big in a way, or implement large packages in a way that would have sort of reduced the economic damage of the pandemic. On the employment side, the COVID crisis led to a significant contraction in the labor force participation rates, a dramatic rise in the closure of micro and small enterprises, and a remarkable reduction in informal employment that in the past was sort of an escape valve, a valve that countries could use in periods of recession. Here, given the lockdowns and so on, there wasn't really any opportunities for the informal employment to play any buffering role. And given that informal markets are so big in the region, this explains why Latin America and the Caribbean countries suffered so much also in terms of employment. So a big shock, a pandemic, something that wasn't expected, and so on, a very limited ability to respond to the crisis in terms of offsetting fiscal stimulus and so on, and some deficiencies in terms of the health infrastructure and the patchy enforcement of lockdowns that were bad in terms of what what they meant for the region. So I think those are the factors that explain why the region was hit so hard by this pandemic.
Very interesting, the insights about labor informality. The report states that 58% of the workforce in the region is informal compared to 15% in the USA. I mean, why is the informal workforce such a large percentage of the economies in the region?
So, yeah, so we have some structural deficiencies in labor markets in Latin America that explain or are behind the high levels of labor informality that we observe. And something that is sometimes not very well appreciated or entirely understood is that sometimes, we have implemented policies with the very best intentions, trying to support and help people and so on, but with the unintended consequence of increasing or worsening the problem of informality. So, for example, in the region, we, what's one problem with informality? One problem with informality is that people that work in the informal sector do not have access to, um, health benefits and pension benefits, because those are somehow bundled with the formality status in the job market. So, given that so many people don't have that kind of protection, governments with with very good intention have tried to provide benefits to those people, or transfers to those people, to compensate for the fact that they do not have access to those uh, packages of support that are associated with working formally. Now, the unintended consequence of doing that is that providing those transfers based on the condition that you do not have a formal job is like giving you a subsidy to remain informal. It's sort of lowering the cost of informality. So, one thing that we are proposing, for example, countries to consider is to rethink the kind of support that you give to try to generate incentives towards formality rather than to subsidize informality. So, for example, in the macroeconomic report, we talk about this negative income tax. Okay, what is the negative income tax? For those of you who are from the U.S. Or follow issues in the U.S., you may have heard about the Earned Income Tax Credit, the EITC. Okay, well, the idea of the negative income tax is based on that concept, and the idea is that you provide a credit, a tax credit, um, for working formally. Okay, and the tax credit does not disappear if you work more formally. Sort of, it's phasing out as you make more and more income, but it's always more convenient for you to work formally than to work informally, because it's not that if you work formally you lose the credit. No, you get the credit, and then as you make more money, the credit is phasing out, but you will always want to work that extra hour, because the compensation of working that extra hour will be higher. Well, that very basic principle provides sort of an avenue or a route through which you can subsidize formality rather than subsidize informality, and would be a way of helping the formalization of the labor market. So we need to address some of the problems that have sort of perpetuated the problem of informality in our labor markets, because then, and probably you will ask me about this, informality is also very much intertwined with the tax evasion. Another problem of informality now, not for the informals themselves, but yes, for the economy, is that to the extent that you work in the informal sector, or the transactions are informal and so on, those kind of activities are associated with tax evasion, income tax, transaction tax, and so on. So the government cannot raise revenues from informal activities, and that sort of generates a negative feedback loop in terms of the fiscal solvency or the fiscal space for countries. So, informality is also a problem in relation to the fiscal frameworks and the fiscal soundness of the countries. If we want to fight tax evasion, we also need to fight informality.
With the time we have left, I'd like to turn to climate change, a very important topic. And you've done some important research on the topic of indirect effects of climate change on GDP growth and income inequality in the region. First, your research indicates or establishes that the frequency of natural disasters seems to be rising, and there seems to be a connection there with climate change. I want to show you, if I may, one of your slides, which illustrates this effect. Could you please quickly walk us through this slide?
Yeah, so this is the total number of disasters by region, and it combines both the so-called hydrometeorological episodes, things such as storms, floods, um, 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 uh, and hurricanes and so on, and the geological episodes, which are earthquakes. So what we see is sort of an aggregate trend over time in terms of an increase in the number of these types of events per country over the decades. Okay, so if you take the case of Latin America and the Caribbean, each country on average in the 1970s was suffering about 5 of these events per year, and now over the decade, sorry, and now each country suffers about 12 on average, given the most recent data, and all of the regions more or less show this trend. I mean, if you were to disaggregate this, and we have done it as well between the events that are more closely linked to, or episodes that are more closely linked to climate change, such as the hydrometeorological events, and those that are not associated to climate change, which are basically the earthquakes, you would see that what drives um, uh, this increase is precisely the hydrometeorological events. I mean, those events that are becoming more frequent and more intense given climate change patterns.
The next slide I'd like for you to talk to speaks to the point that indirect effects of natural disasters is a strong and persistent negative impact on economic growth, which is manifested in GDP levels. Could you speak to this slide?
Yes, absolutely. Well, this slide in particular is also the frequency of hurricanes that you observe in what is called the Caribbean Basin, which includes the Caribbean islands and also the Central American and continental countries that have a coast facing the Caribbean. And you see, as I was explaining in the previous slide, you see sort of this increasing trend of more and more of these hurricanes affecting the Caribbean basin. If you go to the next slide, is the one that you were alluding to. So what we have done here is look at the history of the incidence of these types of shocks on GDP, and we group them together. We put the start of the episode at the time 0, and we look at the evolution of GDP before and after the incidence of these types of shocks. And what we find is that on average, output falls by about 2.2 percentage points of GDP after each one of these episodes. And importantly, even though there's always a recovery following this kind of shocks, because there is destruction and then there is a recovery, on average, the extent of the recovery is not enough to make up for what is lost. So it's kind of, there is a decrease in GDP, and then there is recovery, but the recovery is not enough to offset all of the losses. And you see it very clearly in this figure in particular. When you look at GDP growth, You see, it collapses during the year of the shock, then it recovers. But look at the average growth rate, which is the dashed line after the T0. The average growth rate after the disaster is more or less the same level and even a little bit below the average growth rate prior to the disaster. So what we wanna highlight from this is that sort of at the aggregate economic level, this is where people talk about this indirect effect. At the aggregate economic level, these kind of disasters, these kind of shocks have a negative implication for the economy that is quite significant at the macroeconomic level. Then there are the microeconomic impacts, which is basically the impacts on the poor and on inequality, and those are not observed here. This is just the macroeconomic impacts.
So this segues into the inequalities that the natural disasters are creating in the region, and your research shows that the communities in the region that are impoverished are more vulnerable to climate change than non-impoverished communities. Could you speak to that dynamic?
Yes, because the impoverished communities are usually also located. There's a couple of reasons. No, one is usually they are located or they live in areas or sort of lower plain areas that are sort of more at risk given some of these disasters. So the placement is one factor that increases their vulnerabilities. Usually, their dwellings are much more basic and less sort of capable of resisting the speeds of winds and the damage that may be generated by um, these types of disasters. And third, low income population, poor people usually have much less resources, much less savings to be able to afford the cost of losing a job or dealing with somebody that got hurt in their household or things like that. So the poor, the most vulnerable people tend to be affected disproportionately more by these types of shocks. So that's why every time there is one of these shocks in the aftermath, you tend to see that the impact is bad in terms of increases in the level of poverty or increases in the level of inequality.
And what are the policies that are necessary to remediate this dynamic? You speak in your research about preparedness policies compared to recovery policies. Could you speak to that dynamic?
Yes, so we need good adaptation policies that help people prepare and be ready to deal with these kind of shocks that are becoming more frequency and in some cases more intense. So, for example, from a public policy standpoint, everything related to improving warning systems or improving building codes to prevent the collapse of basic infrastructure and apartment buildings and things like that. I mean, it's something that you need to take into account into the design and the planning of the public policy, because dealing with the consequences of it is usually much more costly and difficult. So this is sort of incorporating the risk into the planning and decision making process such that you can sort of get the economies ready and to support. And then, for example, all of what has to do with the investments in health infrastructure, not just the physical infrastructure such as the bridges and so on. You need to have sort of a robust health infrastructure, because health systems are usually stressed in the aftermath of these types of shock. We had sort of an extreme example with the pandemic, And again, I think that, the poor health infrastructure we have in our region showed up as an element that explains why we had so much suffering and human loss. And in the case of natural disasters, shocks are much more sort of contained, focalized, and so on. It's not a global pandemic, but the health systems of the areas that are affected suffer the same kind of stress that we saw, and we need to be ready and prepared to respond to that, particularly in a world where, unfortunately, we are seeing, again, these events being more frequent and more intense in some parts of the world.
Well, Mr. Cavallo, thank you very much for your time. The work that you're doing at the IDB is critical and very important. And we need this clarity that you're giving us in the region to move forward productively and positively post-pandemic. Your time is valuable, so I chose to take the questions that we have, and we're going to send them to you, and hopefully we can get them answered offline. But I wanted to use this valuable time with you to get all of these topics covered. Thank you so much, and we appreciate your time, and we'll be following you from here in Panama.
Thank you very much, and hopefully next time we can